tomorrow morning, you will get all the important points in an announcement. How you'll find the exam, it's going to be online, what your timing is going to be, accommodation letters, all this stuff that I stated about the exam, I will memorialize in an announcement and send that announcement out to everybody so that everyone's just got the information in front of them. Okay. And as you know, all I'm doing now is trying to go through some review. Now, 10 and 11, in my mind, sort of relate more to an investment course. There's not a lot of financial management in here, so they're not super important, which is why we didn't necessarily go over them. But I do want to at least make sure you're aware, because there will be some questions from these chapters on the exam. All right. And so effectively, what chapter 10 talks about the most, even though it's entitled Lessons from History, is about calculating returns. And how do you calculate historical returns, average returns? So there, this is actually the core concept for investment courses. So if you take any or will take some, or even just thinking through your own portfolio, there is a direct correlation between risk and reward in an efficient market. If the market's working properly, then the way this is supposed to work is the more risk you take, the more reward you get. All right. And where the market breaks down, or where this relationship breaks down, is when something goes wrong with the information flow, with the efficiency of the market. And we've seen this profoundly with crypto. All right. And today I was just looking at one of the big crypto lenders, Silvergate Capital, and their stock got crushed. It went from almost 220 down to 7 in the space of about 8 months. And what happened was that they got tied up in the FTX thing, and there was just a ton of lack of focus, lack of sort of professional analytics, and misinformation. And the combination of those three essentially hurt a lot of people. I mean, so the employees at Silvergate got hurt, the investors in Silvergate got hurt, the investors in FTX got hurt, the customers of FTX got hurt. And you can throw Robinhood in there and Coinbase. I mean, it's been a real whirlwind that has to do with in its core breaking the relationship between reward and risk, because to do that, you have to understand the risks you're taking. And the applicable part about finance is finance gives you the skill to look in the future and analyze that risk in the future. The problem is that because in a sense we're so overloaded with information, we have so many informational resources, that it's kind of hard to analyze the risks today. It's a hard thing. We've got all this information going off at us through our computers, through our televisions, through our tablets, through our telephones, and then the person-to-person stuff, and it's hard to figure out what's right. You look at, there were a lot of smart people got taken in by FTX and got badly hurt. And it's not obviously not the only case and not the first time. But at the center of this, there is definitely a correlation between risk and reward. But what really happens in the investment world is that information creates opinion. And then the summation of those opinions creates a definition of risk. And that definition of risk creates market movement either up or down, which defines reward, right? The basic theory is the greater the reward, the greater the risk. The greater the risk, the greater the reward. They're inexorably tied together. But we have a very, very hard time understanding the risks in the marketplace these days, right? And there's this information flow is definitely problematic. All right. So the return calculations, yeah, fine. Relatively simple math, simple stuff. Capital gains should be a concept you all understand, no problem. Dollar return, this is where dividends become applicable over a period of time. If the company you've invested in pays dividends, then you add those to the capital gains or losses that you've experienced in buying and selling the stock, and you come up with your period return. All right, and actually this sort of outlines where dividends can play a role, because in a highly volatile market that is not doing well, dividends can protect the investor. The problem is, as I said, that we've broken the concept of once a company pays a dividend, it always tries to pay a dividend. And we see that profoundly with some companies like GE, that after 72 or 73 years of paying a dividend, they continued to pay a dividend, but instead of the dividend always being either the same or growing, they cut their dividend dramatically. So dividends aren't what they used to be, but they do play a role in calculating total returns. Percent return is obviously very simple. It's your dollar return divided by dollar invested. And the thing that the book sort of doesn't tell you is that you do want to time weight it. So, investing in a stock at 50 and making $10 in 3 months is not a 20% return. It's a 20% period return, but the period is 1/4 of a year. So annualized, that returns 80%. And that's an important factor in figuring it out. And they give you a whole bunch of formulas, which is fine. This is all really simple math. I do want to point something out to you that I think is very interesting, and this graph points it out or illuminates it. So the least risky thing you can do with your money is buy treasury bills. All right? Treasury bills are issued by the U.S. government. They're guaranteed by the U.S. government. They are issued at a discount, and they mature at face value. They're never longer than a year. So the bill portion of the government bond market or treasury financing market is from 12 months down to, sometimes they issue what's called cash management bills that can be a couple of weeks. So whatever the term is, you're buying it at a discount. It's less than a year. The U.S. government is never defaulted, and even though we keep bumping up against our debt ceiling, I don't expect they'll default. So it's considered to be the least risky investment you can make. And no surprise, therefore, if risk and return are highly correlated, that treasury bills provide the lowest return of all the other investments you can make. What I found really interesting is as you go up in risk, so you go from treasury bills to governments to corporates, and then large company. Do they do corporates in here? No. Do they just do long-term governments? Sorry. And then they get to large company stocks, and then they get to small company stocks. And no surprise, small company stocks are the most risky investment you can make. It's risky because the company's got generally some capital problems because it's a small company, so its access to capital is not as good as in the big companies, and they're often don't have as diverse a workforce or diverse as a product set. So there's just a lot more risk in their business model. And what I found interesting was how big a return you could get, right? So this calculation was, now it's 90 years, right? So effectively, if you put $1 into small company stock in 1925, right before the Depression, and you held on to it, right, by 2014, it was worth $27,419. What this doesn't take into account is diversification, which is probably the most important element in risk management in an equity portfolio. So if you had bought one small company stock in 1925, you had a pretty good chance that by 1929 or 1930 or 1933, in the depths of the Depression, the company would be out of business. If you bought 100 small company stocks, you had a good chance that I don't know, 10%, 20% of them would survive. So if you bought 1,000 small company stocks and you put $1 into each one of them, right? So you've invested $1,000, and if only 10% of them survived, so you only had 100 active companies by 2014, right? You would have had $2.7 million in market value. So diversification, this chart doesn't illuminate that, but diversification is a very important thing. But you clearly on this chart can see the correlation between risk and reward, right? And so here's a breakout by year, and of course inflation, as we know, plays a big role. So there's a nice chart on CPI, and as I said, you can see here if you sort of go up your risk component. The least risky average return was 3.5%. The next least risky is 6.1. You get to corporate 6.4. And by the way, I want to point out that there's not a lot of yield differential between long-term corporates and long-term governments. And then you get into the stock market, and you can see that the returns in the stock market are substantially more than the returns in the bond market. And this is why the stock market is substantially more popular than the bond market. There's more money over in bonds, right? I mean, the U.S. government is now, 33 trillion in debt. We're financing it all in the bond market, and it's going to roll over a couple of times. So our government's going to account for, I don't know, 40, 50, 60 trillion of debt over the next couple of years. There's a pile of money in the bond market. And investors who put money into bonds generally are just looking to get interest and to get their money back. And if they get some capital gains along the way, that's nice. Stocks, it's all about capital gains. And obviously, there's a lot more risk than, even if there are dividends, there's no guarantee that dividends are going to continue. There's no guarantee you're going to make money on the stock. There's no legal requirement on the part of the market or the company to give you your money back. So there's a lot more risk over here in the stock market. And you can see this profoundly in the rates of return. So I've talked about the risk-free rate, right? The risk-free rate is treasury bills because you buy them at a discount. The government hasn't defaulted on their obligations ever. I don't expect they will. So you don't have a reinvestment risk because you're not getting a coupon. You're just buying at a discount, and you hold the darn thing to maturity and you get your money back, right? So the risk-free rate is generally considered to be the 6-month treasury bill rate. The risk premium is what you get for bearing risk, right? No matter what market you're playing in. All right. And here you can see the historical risk premium. Again, governments and corporates very close, treasury bills 0, small stocks 13.2%, obviously much greater than the large stocks at 8.6, right? So this all is relatively standard math, and I just want you to understand the concepts. I'm not going to ask you to calculate the sigma squared, or the sigma, the standard deviation of a portfolio or a share. Just understand this is all about variance. It's all about dispersion of prices over a range of prices for a security. So this is sort of standard portfolio management theory, which is why I'm not 100% sure it belongs in financial management. All right. This has some personal interest, I presume, to a lot of you. So, I definitely want you to be aware of it, but effectively, this belongs more in my securities analysis course than it does here. So I'm not going to go very deep in these chapters. All right. And certainly understanding that small cap stocks are more risky than big cap stocks, that's a good thing, right? And it certainly ties into chapter 15. I mean, understanding the distribution of returns over certain assets, this is sort of deep portfolio management stuff. Don't worry about it. I don't know why they put this in the textbook, but they did. So, and I know people are interested, so I assigned it. But the reality is that supply and demand is the most powerful force in setting the price of every financial asset in the world, whether it's gold, real estate, art, stocks, bonds, options, doesn't matter. It all comes down to supply and demand. Now, these mathematical calculations and mathematical concepts will have an influence on supply and demand, but it comes down to supply and demand. And again, as I said, because of the impact of information that we get today, the reaction on supply and demand to this information flow can be very profound and very powerful, right? So here's, this is something a lot of people don't realize, right? But back in '87, which is what, 35 years ago, right? 36 years ago, sorry, or about 35 and a half. Back in '87, the market collapsed in October. And it scared a lot of people. And it scared a lot of people because it was more profound than the 2 worst days of the crash, right? So another thing that this chart illuminates, that I think is very interesting, is we take the date of the crash as October 29th, when in reality, the worst day was October 28th. And these 2 days back to back, from my perspective, validates what I've always said, excuse me, about the Great Depression, which is that the government caused it. And what I mean by that is that the government, in order to promote common citizens in investing in the stock market so that companies that needed financing didn't have to rely on government financing and didn't have to rely on bank financing, but could go into the stock market and get private financing through the stock market, the government changed margin requirements to 10%. So put down $1 and buy $10 worth of stock. So what happened was that again, I don't know how much you've looked at economic history, but we had fantastic years in America in 23, 24, 25, 26, 27, things started to erode. By 28, it was apparent that we were having some economic problems. So the market cracks in October of October 28 of 29. And what happened was we had a zillion margin calls. And so a lot of people got frightened, liquidated their shares. A lot of brokerage firms got frightened and forced liquidation on their customers. And so by October 29, people were being sold out. If you read stories about the Depression, people were so upset they were, literally committing suicide because they had a big drop in their value. I mean, especially look, if you'd only put up 10% and October 28 happens, you have no equity left, but you still owe that loan to whoever loaned you the rest of the money. And then the next day it happens again. So in those 2 days, the market lost effectively 34, 35, 36% of its total value. In an era where margin was 10%, obviously, that caused a lot of damage very quickly. And this was because the government made a decision about helping, attract private capital into the stock market without thinking through, what happens when we have a down day? Oh, we just destroy everybody. So effectively, but as I said, October 87 was worse, believe it or not, even though it went down almost as much as the 2 days in 29 combined. The difference was that we had some warning. If you were following what was going on, you could see some erosion starting in June of 29. October of 87, you didn't get much warning. Things looked pretty good. I mean, share prices were relatively extended, but it scared people terribly. And all you kept reading about was, is this the beginning of the next Great Depression? And people were literally withdrawing money from banks under the fear that the banks were going to fold the way they did during the Depression. Right? So, the rest of the time is, you can see, is somewhat related to the mortgage crisis, right? October 08, December 08. But in general, these are sort of your worst shots at the stock market. All right. So other than that, the talks about, the rest of this chapter talks about simple math. What's the arithmetic average of returns over a period of time versus geometric, and geometric has to do obviously with compounding. Compounding has to do with leaving you the income such as dividends in reinvesting them back into your portfolio. We've talked about this a little bit already with present value, future value, because future value has to do with compounding, right? So you should be somewhat familiar with this stuff, and then it just sort of restates what should be relatively simple to understand, that small company stocks have a greater return, whether it's arithmetic or geometric, and they have greater standard deviation, i.e. they're more volatile, and they're still more volatile, right? And they're more volatile than large company stocks. And large company stocks are more volatile than long-term corporate bonds, right? Which are more volatile than long-term governments, right? So none of this should be a surprise from an intellectual perspective. It's just wanted you to look at this, and they'll, as I said, this is not as important a chapter to financial management as some of the other stuff, but there will be some questions on this chapter. But there won't be, it won't be one of the main sources for questions on the exam. And the other thing I want you just to understand is you don't have to worry about the efficient market hypothesis, because in effect, the computer has made all markets efficient, except that the flow of information has created sort of an anti-efficiency, meaning that by the time all of us get the information to act upon, it's already been acted upon by the people who had the information first. So there's definitely a sense of efficiency to all these markets, but there's a great deal of inefficiency that exists in ways that we can't see, right? And we've seen this, as I said, I think crypto's a great example of that, right? And so effectively, what we've got today is that we're supposed to have a strong form efficient market where all the information is known by everyone, and supposedly inside information is of little use. The problem is that's not the case, right? Inside information is of great value, and it's not going away, and it's still happening, only people just aren't getting caught. And that's just the way, it's just the way of the world. There's nothing we can do about it. So, you can take a look at this. As I said, there's a few questions from this chapter, but in my opinion, this chapter belongs really in an investments course. All right, and so just understand what is an efficient market versus a not very efficient market to a weak efficient market. All right. Other than that, as I said, this chapter really belongs in in an investment class more than a financial management class. And let me just put 11 up, and then we will be done. All right, so 11's about risk and return. Again, this is very focused on publicly traded securities, and this is why I didn't pound on this. We got a little bit of this in chapter 15. 10 and 11 relate to 15, but all the concepts in here are really about portfolio management, right? The impact of diversification, systemic risk versus unsystemic risk, right? Risk return trade-off, the security market line. All this stuff is about publicly held securities, right? Clearly, there are some concepts in here that there might be one question or two questions on the exam, so you can go through this and pick them up. Certainly understanding the difference between systemic risk and unsystemic risk would be important, right? Understanding the concept of beta would be important. The rest of the stuff, this belongs definitely deep in some sort of securities, public market securities course. So don't worry about it, right? The standard deviation and variance part is a structural idea or concept within a lot of different disciplines in finance. So understanding this, and obviously this comes from statistics, is not a bad idea, but going really deep into how portfolio returns work and all, I just don't think it belongs in this course. So there'll be a little bit on this, but there won't be a lot. All right. Let's see, I'll go through this a little bit more just to see if there's anything I can point out to you. Most of this, as I said, even though it's supposed to be about risk, most of it's about risk in the securities markets, and that's the important part of this chapter. As I said, it's not really applicable to the course. Here, finally, slide 18 and I think 19, we get into systemic risk, which is market risk, which is non-diversifiable risk. Understanding that, right, and understanding what the examples are, like inflation, like changes in the GDP, right? That's a good thing, just as unsystemic risk, systematic risk is diversifiable. It's about company specific, asset specific, right? It's unique risk to a specific sector or a specific company. That's good. So understanding slides 18 and 19 are important. The rest of the stuff, as I said, really belongs, and understanding diversification, because diversification does have an impact on corporate management, right? Diversification is what made, all this corporate acquisition stuff that went on in the 60s all the way up through the 80s, made it so popular. That's because of the power of diversification, right? So effectively, this would be another good topic just to read through. So sort of 18 through 21 will give you a sense. And this really created conglomerates. There were, the whole acquisition concept was not really popular all the way into the 60s. And then all of a sudden in the 60s, the concept of diversification and non-correlated revenue streams and non-correlated earnings led to these companies going out and buying companies that had nothing to do with their core business, right? And so conglomerates became a conglomeration of all these separate companies where there was no real correlation, right? And the goal was theoretically to have companies that had negative correlation. So if company A's earnings went down, company B's earnings went up, so that when you consolidated all your various pieces as management of this conglomerate, the earnings looked relatively steady. And everyone loved that concept, right through the 80s, when we realized it sort of didn't work, and that some companies that were acquired did much better than other companies, and they grew bigger. And so, in order for it to really work on a mathematical basis, all the pieces had to be literally valued the same and have the same earnings. All right. So, and this is, again, all about portfolio risk, which, is not necessarily applicable to the course. Understanding beta would be a good thing, because beta is a concept that you can use in corporate management. When you buy a company, you look at the company's earnings correlation to the acquiring company's earnings. And you develop, in a sense, your own beta concept within your company. This applies to stocks, right? And so the capital asset pricing model uses beta to create the correlation with the general market. So here again, it's this is a good concept to understand. And
Professor, could you break down what the SML and the CAL, like how?
Yes, SML is the security market line. It's essentially the capital asset pricing model. I'm not going to ask you any questions on it, but just so you know, it belongs in a portfolio management or public security analysis course, and effectively what it does is it shows the projected price movement of a company's stock compared to the volatility of the underlying market. So beta, which is the correlation coefficient, becomes an important part of that discussion. And as I said, this chapter talks about beta a little bit, and understanding beta would be a good thing. Does that help?
Yeah, and then what about the CAL? the capital, I think it's the capital.
Capital asset line, see it?
Yeah.
Yeah, it's essentially the same thing. And you're not going to get tested on it. It doesn't belong in this course. I don't even teach it in my securities courses, so don't worry about it. You can rip that page out of the textbook. Sorry, did I answer your question?
Somewhat.
Well, okay. Well, keep asking. What?
No. It's just from my own reference because I get confused with the two sometimes because it seems very similar, but I guess with the SML, I see it's used mostly with the CAPM.
Right.
But then with the CAL, I guess when they're talking about like expected returns, that's mentioned, but I just don't fully understand the concept.
Okay, well, I don't want to take everyone's time, but I'd be glad to help you. So if you want to shoot me an email, and I'll send you back some information.
Okay, thank you.
Okay, because I can tell you one thing: it's not going to be on the exam, and being respectful of everybody and their time. I'd love to talk to you about it, but let's do it offline. Right, and this is a pretty good explanation of the security market line. If you want to go deeper into it, you can, but effectively, the security market line is the capital asset pricing model, right? And so that I think that pretty much covers the chapter. Let's see here. Yeah, okay, so I've sort of gone through everything. I've tried to give you some highlights and some also relieve you of some of the study process. Hang on one second. There we go. Sorry. What I'm trying to do obviously is be respectful of your time and help you focus your studying to help you perform better on the exam. We've got a week. I'm not going anywhere. So if you have questions while you're studying that you would like me to answer, I am more than happy to do that. And hang on one sec, there we go. I am easily findable. As you know, you've got my cell phone number, you've got my email address. I'll be working, virtually every day for, until the exam. So just contact me. Let me know what you need to know. Send me a text. We can set up a meeting if necessary. Send me an email. I'll try and answer your question through email. Let's make sure that no question goes unasked and unanswered up until the final. All right. Any questions? And I will send out an announcement probably tomorrow morning maybe tonight, that will again restate the chapters, the format of the exam, the timing of the exam, the place of the exam. Any questions you might have, I will try and answer in that announcement. And I said, I'll probably do it tonight. And then if you have questions over the weekend, you can reach out to me. All right, folks, anything else? Okay, well, let's say good luck, and see you all in a week. Oh, and by the way, I will be the exam date. Obviously, I will be available. What I generally do is I open up a Zoom room and I sit in the Zoom room, so you can just pop in if you need me. So effectively, you'll have 3 ways to find me. Will be text, email, and Zoom. All right, so the day of the exam, you should have no problem finding me. All right.
Professor, I had one thing real quick.
Sure.
When you get the chance, we could do it after, or I could give you a call or anything.
Well, we let everyone go. And,
yeah, no problem.
And you and I can